So today is all about understanding your risk assessment. So hopefully you've probably looked at the AUSTRAC information now and downloaded it all, or you're deep in the weeds of thinking about what it is, why it matters, and here you are with us to discuss all of this. Just 1 second, I've lost my thing here. Oh, I broke it already, didn't I?
While you're getting it back on screen. So look, so this is not a compliance lecture. We want to make it practical and easy to understand. Dare I say fun? No, I'm not going to say fun. Clayton had something around loving your risk, and absolutely that is the mindset we need to be taking. You know, the risk is not the scary part, it's the useful bit. It's really the engine that drives our entire AML program. So we'll talk about that a little bit later. And just to also say that LYRA actually stands for Love Your Risk in AML.
Love it.
I am a geek. So this is just an information session. Feel free to ask questions, and we're also around after the session if you need to have a chat. But yeah, that's you.
Yeah, cool. Oh, look, it tells you about, just the standing onboarding with Seamlss does a lot of this, but it's not quite enough, and that's where we just need to understand the risk and the risk assessment, and that's what we're here for today. So hopefully you'll get a lot of that out of it today. I put this up for Ags, and she loved it because she wasn't really fully aware of what accountants do, and that's the whole thing. We've been doing risk assessments the whole time we've been doing this. It seems like a bigger issue with AML and the language, and it's all wrapped up in that difficult legal speak. But as accountants, we do this all the time. You're already looking at whether the client is a straightforward client or they're messy. Does their ownership make sense? Do they have risk attached to the ownership type? Do they have offshore links? Are they processing things onshore, offshore, at home, in an office? AUSTRAC's not asking you to be a detective overnight. They're asking you just to document what your thinking is and how you're applying it consistently. And we all need a documented process for what services we provide, the types of clients we're talking to, where we're doing it, and what ways we're doing it. So sorry, Ags.
I was going to just add, so just in terms of the basics, MLTF, money laundering, TF, terrorist financing, and we also have another component, PF, proliferation financing, which within this geopolitical state that we're in at the moment, actually, I think globally increases overall. So that's around weapons of mass destruction, financing weapons of mass destructions, or WMD, as we call them. You may hear that acronym as well. As you know, AML is a Bible glossary of TLAs, three-letter acronyms. So they are littered throughout the entire.
I love it.
Legislation.
One day I'll remember them all.
One day you will. Yeah.
One day. So it's about identifying those parts of the practice that might be exposed, and this is why it's come about, isn't it, Ags? Like, the money laundering around, it's been, if you watched the other forums, you know that it's been around for a long time. And I think I will, do you want me to let you talk into this slide, Ags?
Yeah. So look, just on here. So what we wanted to show you is the key message around why we're doing what we are doing, right? So accountants already apply risk thinking every day. This new legislation is not an entirely new mindset for you guys. It's just a different lens, as I've mentioned in the past. So what we have here is, why is the risk assessment important for accounting firms and all of Tranche 2 and Tranche 1? So if you look at Australia's national risk assessment, so what AUSTRAC have done is Australia as a country has been assessed against our money laundering exposure risk. We're high. We've been assessed around proliferation financing risk. It's medium, and I'm thinking that medium might go to a slightly darker shade of color with the geopolitical exposure that we're going through now, and terrorist financing, which is low. The accounting sector is rated high. The rating is not going to change. It's a fairly stable high. It's been a high for quite a while. The vulnerability is medium, and it really relies on the proliferation financing and links to the risk that you might unknowingly set up structures such as companies or trusts that they then use to generate revenue for weapons of mass destructions. And obviously this will link through to sanctions evasion, potentially through the complex structures, because the ultimate beneficial ownership might be obscured. Terrorist financing has been deemed low, and the use of accountants to finance terrorism is generally not that common. It does occur, but it would generally tend to involve not-for-profit organisations or charities that are exploited to, and you might be caught in the middle if you're setting up an NPO. They've certainly been used in the past in countries like UK, where a false charity is set up with purpose on paper for one reason, but actually it's generating income and revenue for a very different purpose. Why are you targeted? And what I mentioned earlier as well is, the key concept of a risk assessment is really the engine of your AML program. So the risk ratings that you'll define, and we'll talk about them later, you have generally a high, medium, or a low risk. And in terms of the high, medium, and low, high, if one of your customers ends up being high, that leads into enhanced due diligence, which is an annual review. A medium is standard due diligence, which is every 2 years, and low is a simplified due diligence, which is every 3 years. And why do we have these risk assessments? Is because accountants can be, I've already mentioned, utilize complex corporate structures. You set them up routinely, and criminals love those kind of structures because they obscure the ultimate beneficial ownership. You can also move funds from multiple entities. So you could help a client manage group cash flows or intercompany loans, distributions. And if you're not aware and not alert, you might actually be facilitating the movement of criminal proceeds of crime through what looks like a legitimate chain. High value transactions, so business sales, property purchases, equity financing. I'm sure many of you don't have those, but that are risk exposures, and in particular where there is international exposure, and obviously if there is any source of funds being obscured, whether it's through deposit structuring or manipulation of valuations or complex trust arrangements, you may be unknowingly utilized, or those structures will be unknowingly utilized to obscure the funds, the original funds. So it doesn't mean that all of your clients are going to wind up in this way, but this is the kind of bigger picture around why you're doing the risk assessments and what they lead to, because they lead to a different set of controls and things that you do on each of your clients.
I think this is where, in the group chats and conversations I've had, lots of firms are like, why are we doing this? Why are we doing AML? And if you're looking at this from an Australian lens, it's the Australian risk assessment. It says that Australian accountants have a high risk of being targeted for this. We are experts, we are the professionals, and they're trying to exploit our ability to legitimize their business. Their illicit activities become legitimized because we are so good at what we do, and they are able to money launder different money through different processes, and we might be setting them up to do that without even being aware. But that is why we are doing AML, because we can help stop it. Is that fair to say, Ags?
Absolutely, absolutely.
So what does it look like with the risk assessment when we examine it, Ags?
Yep. So so there are 4 components to a risk assessment, or 3 factors or 3 parameters, whichever way you want to look at it: services, clients, delivery channels, and jurisdictions. So when you do a risk assessment on the 4 core risk factors, you'll need to look at all of those across each of your clients. In terms of pillar 1 on services, so you need to start here. So what actual services are you providing to your clients? Some they can be found in table 6. I'm not going to go through them all. We've had session on these earlier, but they're essentially things like assessing with buying or selling or transferring of body corporate or legal arrangements, receiving or controlling somebody's money or property, assisting with equity or debt financing, selling or transferring a shelf company, and also providing or assisting with restructuring and becoming a nominee shareholder or a director. So some of these will have a higher risk for money laundering than others. It's important to note that not every one of your services is a designated service. So what does it mean? It means that if one of your services is not a designated service, it does not go to the AML pipe. You don't need to risk score it. In terms of the second lens, which is your client lens, so what kind of clients are you onboarding? Is it a complex structure? So complex structures are inherently higher risk because they make it difficult to identify who the ultimate beneficial owner is, and the more layers it is, the harder it is to actually trace. Is your client a politically exposed person or a PEP, or are any of their controllers or directors within the entity a PEP? So a PEP is an individual who holds or has held in the past public office, plus their family members and close associates. Foreign PEPs are immediately classed as a high risk, and domestic PEPs, which is Australian politicians and public officials, are medium. And why is that? It's because PEPs generally have access to public resources and decision making, and are more vulnerable to bribery and corruption. Also, clients with unexplained wealth, so a client whose lifestyle or transactions are completely inconsistent with their known income or asset, is obviously a red flag or a trigger. The third pillar, and of course, sorry, I can't forget clients linked to high-risk jurisdictions. So if your client or their ownership structure has links to countries that are assessed as a high risk for money laundering, that also elevates their individual risk rating. Trust, again, has a risk of opacity because it's not clear always. It may be difficult to work out who the ultimate beneficial owner is. Or it can be artificially obscured, and also charities and NPOs have a higher risk to, as I mentioned before, terrorist financing. In terms of delivery channels, you've got either someone is face-to-face or digital, or video conferencing or online. So face-to-face has the lowest risk because obviously you're engaging, you see the people, and you will check their ID physically. That's probably happening less and less, right, Clayton? I mean,
we still do a lot of face-to-face, but
yeah,
there's definitely a lot more digital generation and a lot more digitalization of our practices, but there is still a very face-to-face aspect with clients.
Yeah.
Just awareness, isn't it?
Absolutely. Second is email has high risk. So you could easily fake identity documents, and email addresses can be spoofed, and you cannot potentially identify who you're dealing with. Video conferencing and online platforms also have higher risk, in particular when you're linking back to fraud. Deepfake technology means that your live video calls, I'm not saying that's going to happen, there's obviously could happen, and does not guarantee that you're looking at the right person. And of course, with the advent of maturity in our AI, that risk is increasing as AI gets better in terms of generating images. And obviously phone also does have some risks because it's risk from spoofing where phone numbers are impersonated, and there's also voice manipulation. The banks have already stopped utilizing voice authentication because voice can be manipulated and utilized. So those are the 4 key components with some risk factors, and they underlie your individual risk assessment for your clients, but also for your company. Anything to add to that?
Yeah, look, and I said to the Ags, like, it's just the way we talk and the way some people just, for me, it's who, what, how, where. Whereas for AML, the language is a little bit different. Same outcome, but I feel like how you interact with your clients is also going to impact the way you deliver your AML process. So, if you are dealing with someone only online and it's only through the website, you never meet them, you never call them, you never talk to them, then your risk is probably a lot higher than it needs to be. So there are certain ways that you run your practice and attract certain clients, deliver certain services, and where you hang out that are going to affect the way that you approach that risk with your clients. Is that a fair assumption, Ags?
Yeah, absolutely.
So,
sorry, go on.
You're right. So to reduce that risk, and that's what I'm sort of thinking, like if you're only dealing with someone over email, then you're making it a lot harder on yourself. But I feel like if you can design your practice to reduce your own risk, then you're probably going to have less problems. But that's probably assessing where your firm risk sits.
Absolutely. And look, we didn't talk about, I handed over to you without talking about country, the last pillar. So geography, so every country that you deal with, whether through the client themselves or through their ownership structures and their counterparties, need a risk rating. So we can utilize some of the Basel AML indexes. FATF stands for Financial Action Task Force, which is a global kind of watchdog that ranks countries and provides some general guidelines. So they're actually coming in at the end of this year to assess our framework, our country framework for anti-money laundering. So they have their own FATF have their own high-risk jurisdiction list. The Department of Foreign Affairs and Trade, DFAT, also have a consolidated sanctions list. So what you need to do is to create, also, I've just got a bit of background noise. If you go on mute, that will be great. Thanks.
Daniel, fix that, please.
Thanks, Dan. Where am I? So the key point is that the country risk is not just where your client lives, the country where their body corporate was incorporated, the country that the beneficial owner is resident, as well as the country that any counterparty is based. So if your client is an Australian citizen, but the trust is owned through a Cayman's company, the Cayman Islands needs to be included on your risk assessment.
Sorry, just bringing it back up for myself. So I guess the point here is it could trip firms up if you're only looking at one lens in isolation. You just go, oh, I've got these customers, therefore I'm fine. But you're not really looking at the customer is hanging out in different countries, that you're not looking at it because you're only looking at one lens. You kind of need to look at them all to get the full picture and assess how that service might be higher than you realize because you're combining multiple things together to make the risk higher. Is that fair to say, Ags?
Absolutely. Yeah, so they absolutely all need to be looked at together within a model. And I think we'll talk about it in a moment around how each of the risk factors overall determine how they all build together to determine your overall risk for that client. So in terms of how you determine your risk, what's the process for determining your overall risk assessment is firstly, so I've termed it as 4 steps. I think in the Austrac guide it said 3 plus a final output, but I actually think it's 4 steps. Firstly, identifying your exposure. So what designated services do you provide to what client? And you would need to work through, and we can certainly help with that, is the list of the designated service that you provide and how we're stating whether they're high, medium, low, and then what types of clients you have, what delivery channels you have, what new and emerging technologies you are utilizing, such as AI. And then you go into your risk appetite. So what the risk appetite really is your own internal appetite for each risk factor that you'll decide that you want to accept that risk. So for instance, risk appetite on high value transactions. Are you prepared for a client, say, for client transactions, say, of above 1 million. I'm not sure whether many of you deal with high net worths. You may. And if not, what are your thresholds? In terms of physical cash transactions, most accounting firms should put their risk appetite as no for unusual physical transactions. And obviously one of your obligations linked to any cash transactions over 10K needs to be reported back to AUSTRAC. For instance, complex ownership structures. Are you prepared to act for a client where you cannot clearly identify their ultimate beneficial owners? I would say be very careful, right, on that. And if yes, you need to do enhanced due diligence, or if no, you offboard them or you decline that offer. So the risk appetite is really around each of your client areas and which of your offerings. So you decide how you want to operate with that client and with that transaction or within that designated service. Then you need to assess the country risk. So if your firm deals with any country other than Australia, it gets a risk rating. This step is not optional with any international clients, of course. So you need to list every country that appears in your client base, where the clients live, where their companies are incorporated, and where their Benny owners are located. Then you look up each country on the Basel AML index. You record the score. We won't go into that right now, but we can at a later date if people want to go through that in a bit more detail. But I think probably what you're going to automate some of this stuff in Seamlss, right?
Yes.
Yeah.
So I think it's also going back to that AUSTRAC guide, Ags, where it's not like a blank page. It's not like you just pick it up and go, oh, that's it. It is a small win for smaller firms because they can just go, well, I'll pick up that and I'll get started. And it's a start, and it's practically built, but the senior managers still need to go through and apply that process, and then obviously touch on that last bit around aligning it all up at the end.
Yep. So I think you can always override, right? You can always go slightly higher. I think the key thing is that when you're looking at these factors, whether it's your overall exposure, whether it's your own risk appetite, whether it's an assessment of country risk, you do have to think about it and make decisions and document those decisions and be aware of the decisions that you're making, why you're making them. Like, it's not a set and forget, and it's not a I'm going to outsource this to somebody else and just do a tick box. There is like a significant engagement from a thought perspective. This is analytical. You do need to think about it, but of course we can automate with a system like Seamlss as much as possible. But it doesn't mean to say you don't make any decisions, because you still do, right? And it's that handoff between what you do outside the system versus the system that you need to understand, and which are the bits that you need to do outside the system. Is that right? Is that fair assessment, Clayton?
Yeah, definitely. I think it's, mapping it out. The goal is not to make the firm look squeaky clean on paper, and it's this is how we are. The goal is to produce something real enough that's going to drive the right controls for your firm to make this consistent and repeatable. And like I've said all along, I think most firms will find that they're in a low, but you do need some sort of triggers to apply when you see that risk is high. When certain things happen, you've got a process to enact on that. And I think that's just how that risk will drive your AML program.
Yeah, and you just mentioned before we go into that final slide, so the final step is, once you've decided all those components, right, you will then be able to align the controls, right, for high risk, for medium, and for low risk. And that is really the final state, right? What AML controls do you utilize for which risk rating? And we're talking at a very high level here because it's a conceptual thing, and then we can talk a bit more about process perhaps at a later date, and certainly with a Seamlss demo. Sorry, let's go to the next.
No, you're right. So this is kind of saying, well, this is how 1, 2, 3 is assessing your risk, and 4 is how you're implementing it. Is that fair to say? What controls you put in place?
Yeah. The controls is the process. It's what things you do to understand you do at each risk level to help you understand further, because money laundering is really the nub of this legislation is understanding who your customers are. And so what questions do you need to ask and what things do you need to do to really understand who your customer is?
And
And
is
also,
that at what point you do the next level of enhanced due diligence and things like that?
and yeah, we'll talk about that in a moment. And just to add one thing, you know, risk isn't bad. We all know that we need to have risk to operate. It just needs to be an understood risk, right? That you make balanced risk decisions from an AML lens about whether you want to continue with that business.
Love it.
You
And it's
can't
no different,
operate
it's no
with
different to
right?
when you're doing something, someone says, oh, I really want to claim that jet ski. And you're like, I don't think that's a very good idea. There's a high amount of risk to that. You probably get audited and done. But you're assessing that risk depending on what the client's requesting you to claim in that situation. And, you know, if they want to claim something and you're going to explain that risk to them from that tax lens, it's the same as having the AML risk lens.
Absolutely, absolutely.
How does this drive it, Ags? How does this work?
Yeah. So what's the how? So we've done the why. Excuse me. We've done the why and the what. So this is like an AML pipeline in a slightly different visual, right? I think what I want to show you is that the risk assessment feeds directly into your entire AML program. It's not a standalone document that you do once. It is an input that determines what happens throughout every step of client onboarding, as well as monitoring, as well as review. So this is when you see the whole picture, right? You've got the 4 inputs or parameters: services, designated services, client types, what delivery channels, what jurisdictions or countries. The money laundering risk assessment with your 4 process steps, the 4th being what risk rating is defined. So the way that AUSTRAC has designed the risk ratings, the overall risk rating for a client. So if you get just 1 high on any of your 4 risk factors or parameters, that will automatically move the entire client to high. If you have 2 or more mediums, your client's a medium risk. If you're everything outside of those 2 conditions, you're a low risk. So what that means is that for a high, which is what I mentioned earlier, your annual review will be yearly. You will yearly need to check the information that you hold on your client to make sure that it is accurate. You go through what we call enhanced due diligence, or EDD, which means that you ask some additional questions around where the client's money comes from. It's called source of funds, and where their wealth comes from, source of wealth. You do ongoing monitoring annually, as I said, and then you do so, and you also do periodic reviews annually. For a medium client, it is standard due diligence, standard questions, but all those key AML controls follow. And low is simplified, and that's every 3 years. The reason sorry, was that somebody saying no? Yeah. So what else I want to say? So when you are doing ongoing monitoring, just to be clear, you're not just doing CDD at onboarding and then forgetting about it. You are watching transactions, you're watching behavior, you're watching for anything that looks inconsistent. And watching for what the client does that is inconsistent with the activities that you understood them to be undertaking with the designated service that you have provided. Periodic reviews, as I've said, are 1, 2, and 3 years, depending on your risk rating. And this is your scheduled annual check to make sure that the risk rating is still accurate, that the data makes sense, and that nothing's changed. They might have, for instance, branched out to a high-risk country, which means that your country risk or jurisdiction risk goes high, which means they might have moved from a medium to a high. You need to check that every 1, 2, and 3 years. Low every 3 years, 2, medium every 2, and high every 1 year. Suspicious matter reports, you may remember, that's essentially on any client where you think that there is something off, something's not working, something's not reading as it should, and you may smell fraud, you may smell something that just doesn't seem right. and you have a legal obligation to report that to AUSTRAC. You also need to be very wary about tipping off, because this is a protected bit of information. You cannot tip off your client that you're making this report. And I pause. Anything you want to add?
You mean you don't tell the client if you're doing a suspicious matter report? Is that what you mean?
Correct. And also, if anything doesn't feel right, if you're asking additional questions, you also don't tell the client that they're high risk. You just ask information and say this is as a result of our due processes and our global AML regulations. We need to ask you these questions. That's it. You cannot tip off a client.
I mean, you just got to document it. That's all you're really doing, is just registering what happens and the outcomes.
And there's no wrong answers, right?
Yeah.
When it comes to submitting an SMRs, it doesn't matter. If you're not sure, it's better to submit than it isn't, because what AUSTRAC and the other regulators do, they smush all that information together. That I said, actually, AUSTRAC does that because it's actually a financial intelligence unit as well. And it smushes information from all the different regulators, and then it takes that and AFP and all our regulatory enforcement arms of our country take that information. So I would say all information is good information, unless you're making it up, which you should.
Yeah, I think the key that for me to get everyone to take away is you do a designated service, you assess the risk, and then you implement those tasks based on that risk factor. But I think the ongoing awareness and the ongoing risk assessment, that just comes back to the education and the training. So if you can get the education and training to your team while they're in the bookwork, doing the work, and if they notice something's a bit odd, that's when they might flag it and say, we might need to assess the AML lens to this and this transaction. Maybe there's more exposure than they're aware of. It might change the risk rating for that client while you're processing their work or while you're processing the job, because when you first applied your risk rating, it was one with what you knew then, whereas maybe something's changed now and you know something's a little bit different, that may change that risk rating. We're not writing the whole program so it's one size fits all. It's an ongoing assessment tool that you can apply. I'm not saying you have to apply and check it every second time, but I think it's just awareness of how that risk framework works, so that everyone in the firm is aware when they need to put their hand up to make you aware, or the MCO aware, to have another look at it. Is that fair to say, Ags?
Mm-hmm. Yeah, absolutely. And I would also say this, kind of to summarize, low risk doesn't mean no risk, and low risk doesn't mean ignore, set and forget, nothing to do. You still have to do CDD, you still have to monitor, you still review. High risk doesn't mean bad. It doesn't mean you shouldn't do business. It's just an elevated exposure to money laundering. What additional info do you have to get? And I think it's a scale, right? So I think once you start looking at it in that way, it will help. And I think, once you start doing, it will also become a lot clearer, because everything just seems new. Yeah.
Like anything that's new.
Yeah.
There's two assessments, and I think the first assessment will be done when we start registering with AUSTRAC, as we're getting this stuff ready for our firm level assessment.
I don't think you have to do a firm level assessment for enrollment. I think it's due on the 1st of July, but I'll check. Yeah. Because essentially all you're doing is enrolling from end of March onwards, but the obligations aren't all due until the 1 July. But I will check that. I actually didn't. Yeah, I'll check whether you have to do that, the firm level one. I don't think so.
But I think most of us should be pretty low in regards to our risk. Again, I'm making a fair assumption here, but I think you should be able to understand where your risk sits and who you deal with and who your ideal clients are and where they all hang out.
And just to add, sorry, Clayton, just to add, your kind of firm level assessment, that's what you include in your compliance report. So one of your reporting obligations is your annual compliance report. It's due every Jan to Feb in that window. Oh, sorry, Jan to March.
Yeah.
Next year, of course. So then you absolutely include the information around what your firm level assessment was and what you did and what the different parameters were and then why you decided that thing. But also you need to show that you're checking, like an annual check on the risk assessment. Sorry, Clayton, you go, back to you.
No, it's all good. And I think that's just it. We've talked enough about the client level risks. I think people's aware, but I just want to make sure everyone's aware. There's a firm check and there's a client check, and it's all a part of that ongoing risk assessment process. And it just becomes a part of what the firm does. It doesn't have to be overly complicated. We just need to get practical, make sure it's understood, and we'll just keep refining it over time. Like, I'm sure everyone remembers when they first implemented GST or JobKeeper or some other new legislation that they brought out every other week. Maybe it wasn't, you weren't all over it when it first started, but the more you do it, the better you get. And I think that's sort of key, because it's a thermostat, not a thermometer. Yeah.
I mean, and just to add to the thermostat thermometer, it's a scale, as I said earlier, right? You know, and the higher the risk rating, the faster your engine turns in your car, and there's a little bit more that you need to do. Just in terms of the review cycles as well, before I was going to mention earlier, it's at minimum 3 years. I would start checking it annually, or maybe diarising to check it annually, because it may not take long to do, and it might just give you that you're just going to be a bit more agile. Like every 3 years, I think probably once you're more mature in 3 years' time. But for now, I would say it's useful to check these things annually.
Yeah, and I think it's just, yeah, depending on the, you know, all those aspects, you know, the client risks, the structure risks, how the client might be exposed, what controls you're putting in place to just around that risk, and how it can be manageable. You know, some people, you know, got a very good process, so it's very low risk. Well, that's not quite how it could be, because it might be inherently high because of the way the client operates or where they operate. So it's just having the process and managing it better in your firm as to that ongoing part of the compliance. It's not just written once and the job's done. It's measuring that temperature in the room, not once, but ongoing. And look, one of the key things, I think, Ags, you were talking to someone Austrac the other day about having that bare minimum, having a program and just getting started.
Yeah, and exactly. And I think Austrac, as I've said before, you know, it's not about perfection, it's about making a start. In my world of financial services, or in particular banking, we've had very kind of at times complex risk models, because or risk assessments, because they're high volume, right? Lots of transactions, high volume, and in some cases we've had 7 risk factors and parameters. Austrac said that they don't need models right now. It's more around an assessment, like it's a simpler structure. But I think as we evolve, and as the industry evolves, I think they will absolutely look at an uplift from the kind of the bare minimum in terms of how you assess risk to more of a model structure. But that will be an evolution that they will look at, and potentially some of the larger guys in the room may need to take a more nuanced risk assessment or model approach sooner than the others.
It's like anything, as you do it, the better you'll get, the more aware you'll get, and the better your processes and the better your policies, and your whole AML risk structure will improve. You know, so yeah, I guess the key is, I think I'm going to skip this one.
We jumped the gun on that one.
Takeaways. That's where we're up to. Yeah. So yeah, I think for me, it's 2 assessments: one for your firm, one for the client. Obviously, you'll do your firm as part of your AML program, and tailor it, download it. Don't just forget it and stuff it away. Make sure you can update it, improve it, because I think working with your team members, educating them, that'll be where those templates, and get those Austrac free starter kits. Start using it, becoming aware to make it better. Understanding number 3 there, you know, around what will those factors look like? What is the logic that will drive that? What tools are you using to implement it? While I write there, most clients will be low, it still needs the assessment to justify doing less. Like, you can't just assume everybody's low. that will, I think, get you in trouble with AUSTRAC. You have these documents in place and you implement them to help stop money laundering and terrorism financing. Pre-commencement of clients don't immediately CDD. That gives you breathing room. So what does that mean? I think it's similar to the way that ID checks with the ATO. So they brought it out a few years ago, and then they made it mandatory. So you just had time to get that in place, and we've got time now. So from the 1st of July, we do a designated service. We start doing checks. It doesn't mean that every single client in your client base you need to go out and send out and do an ID check or an AML or a CDD. But definitely once you start issuing and completing those services for those clients, that's when we get started with that. So where's Seamlss fit in? So we're obviously that one workflow solution for collecting documents, onboarding, re-engaging. We already do a lot of the data collection of what AUSTRAC sort of required in those documents. The goal is that we're going to implement a bit of a risk rating record somewhere to have that. We're adding the PEPs and sanctions in the next couple of weeks, so you'll be able to have checks on that, download the audit trails and pump that into AUSTRAC when you need to. And then looking at setting review reminders once it kicks over in July. So we are adding a bunch of different AML functions within Seamlss in the coming months. Obviously, most firms aren't even going to do a check for 3 months. But my goal is to start implementing some of these changes to enable us to test them out and show them how that works and get the firm to start using it, seeing how it works. So we'll see how that will come into play. Ags?
Thanks. So we are continuing supporting our clients with end-to-end solutions where we provide you with all the different components, from planning to review of your procedures to the AML program, supporting your risk assessment, implementing the entire thing. We're also doing an AML immersion day, which a couple of people have already been in touch with, and that's like a holistic day where we do a focused and structured session to unpack all of what the reforms mean for you, to go through the reforms, clarify the designated services, work through some key design decisions that you need to make, like how does this legislation or reforms work within your operating model, and you walk away with like a governance and operating model from that day, and you know what you're doing and you get a plan, etc. And then also in April, we're going to be launching some AML staff training modules. So AUSTRAC obviously requires everyone to be trained. What obligations are required for your firm? We have built 6 kind of self-paced online modules that are specifically built out for tranche 2 sections, so they're not overly complicated, but they're easy to understand. We've got videos, plain English, designed for all staff. For instance, all the staff may do 3 or 4 modules, but the AML compliance officer and your directors would do all 6 modules. We've got some financial crime scenarios. We cover everything that you need to expect, and we hopefully keep it as as short as focused as possible. So we'll be launching that in April. And still around if anyone would require some support from an end-to-end perspective.
Excellent. So questions. We've got some things to get started with. We'll go to the questions. Do you want to go to the questions that people have already sent in? Or just go through these first 3? We'll go through the first 3. Which of these services do you think carry the highest risk? I think the corporate structures, like being that the whole point of AML is the highest risk for accountants is the money laundering. So the goal of money launderers is usually for you to set up some structure to maneuver the money around. Is that fair to say, Ags? Do you agree with that one?
Yeah. I mean, also exposures to high-risk jurisdictions. And you will see the high-risk jurisdictions on the Basel table and on the FATF tables. So anywhere that obviously sanctioned countries are a no-go. Sanctioned countries, I think there are 6 now. Sanctioned countries are things like Iran and Cuba and Syria and Libya and Belarus. But then you've got a whole lot of other countries that have higher money laundering risk. So High-risk jurisdictions, I would say, also drive through, and any kind of large cash transactions, of course. If you're setting up a trust for somebody and somebody transfers 650K from somewhere, that is potentially a higher risk transaction as well.
Just being aware. And so how do you onboard a client you've never met in person? Well, that's where Seamlss comes in board. So we can onboard them, collect their data, do the ID checks and AML checks along the way.
Can I just add something to that? When you're onboarding somebody, whether they've come to you via phone or via an email, the onboarding process is the same, right? The only thing that changes is your initial contact channel. The process then follows through, right? So yes, there is a slightly different channel risk, but your flow for onboarding should always be the same for a customer.
For AML purposes, you mean?
For AML purposes, yeah.
So what's your biggest concern? I think my biggest concern is I don't really have any. I think it's just implementing and training of the team, to be honest. It's probably my biggest concern. How do I get the team trained? And I think that's where services like you will come in to assist to train them and make them aware of how to identify those problems.
I mean, if I look at the playbook, right? If I look at the playbook from the banks, I would say for me is people's underestimation or lack of understanding that this type of thing does cut your organization front to back. And the banks have absolutely underestimated this over the last 20 years and up until the last couple of years. So just be aware this does cut, and you just do need to really think about how you're going to integrate it to make it workable.
Yep. I've got a few questions. People want to see what we've got in Seamlss. It will be out in the next couple of weeks. So on the next webinar, I'll be able to show you some more of that flow. We'll be able to step you through what we have in place in the beta. Seems a bit fair on the tech providers if the requirements are, yes, it is a little bit, but the AUSTRAC's been around for years. It's just more of the implementation and making it easier for us as accountants. My goal is to make it so that it's easy for us. So to have those checks on the client platform in Seamlss to make it easier to apply when they need the services. So when you send off the request, if you're aware of there's a service attached, then you can do those checks. Damien's also asked about running existing clients. No, you don't have to run existing ones through. Just run them through the pipeline when they activate a designated service. In regards to the yearly compliance reporting, are there any templates of guidance that needs to be submitted? Current AML program that a firm is using? The yearly reporting, I assume more will come out in that in 9 months' time.
When you say yearly, do you mean the annual compliance reports?
Yeah,
Look, if there was a kit, I would say AUSTRAC will hopefully give us a compliance report kit as well. Reporting.
Yeah. I'm sure it'll come.
To work out, essentially, you take all the different obligations and parameters, and you do a report. But yeah, I think they'll provide us with something. Yeah,
I think so. And that's still a good 12 months away. Leanne's asked, can anyone in the firm become a compliance risk officer, or do we need a qualification level or such a role? I think anyone can do it you think is capable. I don't think you can just palm it off to the little admin assistant at the front if they are not aware of the bigger picture of things, especially in regards to complex tax structures, possibly seeing the financial information within the accounts. I think it comes to a certain point where someone needs to be in that position that can identify when things could be a little bit skewed in that regard for complex structures. Next one.
Just to add to that, the AML's compliance officer needs to be someone who's responsible and accountable, and someone who has the right amount of clout in the organization to stand up for the risk and to talk to the risk, and will be the interface with the regulator. So what you might want to do is you cut that role up. So you might give a part of that role to a more junior level of the staff, so they look across the entire end-to-end AML flow, and then you give the accountability component of it to someone more senior. So the senior person has oversight of the junior, and the senior person makes sure that they can consistently convey and manage the information and risk decisions with their peers at the management level of the organization. And then that individual then goes up into AUSTRAC once the risk has been agreed, discussed and understood and agreed across the managing partners, because the people who own the risk in the organization are the business owners and the partners. You will all own the risk. The AML compliance officer does not own the risk. They're just your person to hold you accountable to the obligations.
Yeah. So training them up to make sure that they're aware to ask the right questions at the right time, and being supported in asking those questions to feel comfortable enough when they're not sure. Damien's asked if Seamlss will generate a high, medium, low. Yes, that is the goal, is to have that so that it's all tracked within Seamlss, so you can have that for your risk assessment purposes and your audit trails within Seamlss. There was several questions before. We've touched on this, I think, on every single seminar. Ags, do we have to do a risk rating for a non-designated service like an ITR? If you have 500 clients doing individual tax returns, it's not a designated service. You don't need to do any risk assessment on them. The pipeline starts when they trigger a designated service. So if you've got 20 clients doing designated service and 500 ITRs, you still need to do an AML risk assessment on those 20 clients and apply that risk rating.
Yeah. As we said, sorry, just as we said, it's your AML pipe, right? Your AML pipe, where does you only open the tap when it's a designated service. Just think of that. Tap, designated service.
Someone's asked, I'm a sole practitioner. I don't create entities. I don't do trust setups or anything like that. I don't do any bookkeeping. I don't do any client fund management. What risk assessment applies to me? So I think the funny thing around this is I've seen some people talking about, I'm a bookkeeper, therefore I don't have to worry about it. I'm an accountant. Maybe I need to think about this. It's not I'm an accountant, therefore I need to AUSTRAC. It's I provide a designated service. So just understand that. You can say, I'm not an accountant, I'm not a bookkeeper, therefore I am absolved of AUSTRAC requirements. No. You provide the designated service, you need to register, you need to do the work. So just by saying I'm small, I'm a sole practitioner, it doesn't just absolve you of this. If you trigger one of the designated services, you need to apply that risk rating process to it. Is that fair to say, Ags? Am I very harsh?
Yeah, absolutely. It's nothing to do with your type of organization. It's all about the designated service.
Yeah. So someone's asked, does filing payroll STP on a client's behalf designated services? Based on my awareness, it's no. Payroll and STP is not a designated service under Table 6. It could be an edge case if you're holding the funds on trust and you're using those funds to distribute them. I think that's where it could get a bit murky. But receiving, holding person's money, that's where it could get a bit tricky. And we did talk about that in the designated services webinar a few months ago, 2 months ago, about the UK client, Ags, where the person gave them the money and then they distributed it and they were doing it unbeknownst to them
within their accounts. Yeah.
I can't remember if it was money laundering or terror financing, doesn't matter. They were doing the work for the client. Does AML apply to a voluntary role such as a treasurer and NFP? I'm not sure if I can answer that. I think.
Sorry, what was the question? Does
AML apply to a voluntary role? I don't think it matters about the voluntary role. So does it apply to the treasurer of a non-for-profit? So would a non-for-profit be issuing designated services? I'm not sure. I think the question is are you doing a designated service? That's whether you need to do anything.
Yeah, the client secondary. That's right. Are you providing a designated service, and then go to the rest. Then go to the rest of your risk factors.
Yeah, and I think that's where it still comes with that designated service. I'm not sure what non-for-profit accounting firm you'd be running if you're issuing designated services. It'd be a bit weird. And I think that's similar to the question around external consultants. What risk is going to go on there, and because the AUSTRAC designed these starter kits, I think, for small firms, but doesn't really always apply to everyone. But I think that's where if you need that external help, AGS is available. There's a lot of questions. Sorry, I'll try and get through them as quick as I can. By completing AUSTRAC's risk matrix document, does that mean we complete our risk assessment? So can we just complete the AUSTRAC one and we're one and done?
Well, if you understand it, and if if it makes sense to you, then yes, that's right.
So, yeah. Making the
Now,
genuine risk appetite decisions for your services and your clients. Like, if it is done, but I feel like you've still got to be aware you need to update it as you go.
Implement it. You need to implement it. So what does it mean for you? And do you understand where it's how it's going to be utilized within your organization? Yeah.
Those
No,
controls.
Completing an Excel spreadsheet is not going to make you compliant. Completing an Excel spreadsheet and making sure you understand what the outputs mean, and it is then, you integrate that output into your business operations, then yes, you will be compliant on that aspect if you're doing something with that info.
What am I required to do? How do I on-charge this service? Look, you definitely could on-charge this service. I have seen a few firms now charging anywhere from $50 to $500 to onboard a client, and there are additional costs in regards to doing CDD and PEP checks and sanction checks and all that sort of fun stuff along the way. There's no set approach to this. There may be something coming in the wind for Seamlss around this, but yes, that's why AUSTRAC designed the starter kits, so that you can work your way through that and what is the cost to implement some of these services. But I do think when you're doing some of these designated services, you will need to factor this in to increase your prices. Yeah, so how are other professionals and industries handling all this? Ags, I think like lawyers, real estate agents, they're all coming in under this tranche too. We're all sort of working through it together. Is that fair to say? Like, you're doing this with some other people?
Yeah, absolutely. And I just think it all is very individual, how people want to pass this cost on and absorb it. Yep. Yeah.
Someone's asked if Seamlss is going to have some functions around risk assessments. That is what we're working on at the moment. So expect to see some of that in the near future. I can't give you an exact date because we're working on some big stuff, but it is on the way, and I want to try and make it as seamless as possible for people to onboard, engage, re-engage, and implement these services ongoing. I think there's another question here. We answered the payroll. Super. It's not a designated service. If we set up a company, so Harry's asked, if we set up a company structure for a client, say in August, and that service is obviously a designated service, so therefore we need to do it. Do we need to keep monitoring that setup ongoing, or does it just occur as a part of that risk assessment? So I think what I'm trying to get at there is, like, we've set up a new company, we've done the risk assessment, it was low. Do I need to do another risk assessment 6 months later, 12 months later, or is it only you're assessing that risk next time if they are high or something? So that ongoing monitoring approach, I guess, is the control question there.
So it's trigger based, right? So has anything changed? So if your client is high risk, you'd need to do a periodic review on them in 1 year, if it's medium 2 years, and if it's low 3 years. But in between then, if something changes in your customer's profile, like they're using a designated service differently, something is different around how they operate, something is different around their basic information, like they change countries, they change addresses, they get another designated service, then all those things are triggers, and that's when you would re-risk rate them. And then at that re-risk rating, you determine, do they go up or down, and does that, and have they changed any other information at this stage? So it's only a trigger event. Yeah.
Excellent. That is all the questions, believe it or not, Ags. We've gone just on an hour because we started at 12:02. It's 1:01. But
it's a big
we've
topic.
done really good.
It is a big topic.
Thank you.
Yeah.
And that's the idea of these forums, is that we want to try and break these topics down to make it easier for everyone. So if you need to go, you can go. There is one more question here from Alison Scholar. What do you have to review at the appropriate intervals? Is the review CDD, EDD process? I think, again, that comes to those controls of what's triggering reviews and ongoing monitoring and their risk rating and things like that. Yeah.
So it's your key data sets, right? It's the key data that you've collected on your customer. You need to check whether that information is still the same. That's what you're checking.
Yep, excellent. Now, my computer's having a bit of a heart attack there. Some people have asked about the next webinar, Ags. So I've got a webinar for FBT coming up in a few weeks. So that's just around how to improve that FBT life cycle with your clients to make that process a lot easier. At the end of that, I'll go through and do some demos and webinar demos on that. So it may go for a lot longer, but the FBT will only go for about half an hour. So if you want to stick around, I believe we'll have the AML stuff in by then. So hopefully I'll be able to demo the AML bits on that webinar in a couple of weeks. That is, what was the date? April the 2nd? April the 2nd.
Second, yes.
Yeah, and I think, Ags, we discussed the next AML one would be...
No, that was the 2nd, and I thought, yeah, or maybe I got that wrong.
I'm looking at the wrong dates. April the 2nd. And the
AML... I thought we'd do the next AML forum April the 2nd, and then you were going to do an earlier one for the
Oh, I thought the AML one was going to be on the
Okay, look, that's fine. But
we'll do it on
I
the
think
9th.
in terms of event, I think we do CDD next.
CDD?
That's the other big one.
Well, yeah. I think we'll have some onboarding questions from some people. If you do have questions or anything, please email us through. Ags's email's there. If I go back a slide, you'll see the Seamlss one. Reach out, give us some feedback, especially if you're finding these informative. So we keep doing them. We're doing this to help you. I think the next few months is probably the biggest change, Ags, with you'll be able to register next month. Hopefully start working through what that implementation looks like.
Yeah, things are getting real.
Sticking into the situation.
Yeah.
Thanks for sticking around. Appreciate everyone's time. And thanks for joining us on the Accountants Forum number 4. Next week will be number 5. And if you do have any particular topics or anything that you want us to focus on, so the next one will be on CDD. I'm interested to know what's that acronym stand for again, Ags?
Customer due diligence.
Customer due diligence. There you go.
If the risk engine is, if the risk assessment is your engine, the CDD is the car, is the chassis of the car, right? It's the nub of the things that we do to understand who our customers are.
Excellent. So that's a bit of the process, how we do things.
And the what. And the what. Yeah.
Cool. So that's on the next one. Yeah. Looking forward to it. Appreciate everyone's time. Yeah, thanks. Have a great day.
Thank you. Thanks, Clayton. See you, everyone. Take care.